Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at McDonald's, stock is up 4% after a Q4 earnings release. That wasn't all that impressive upon first look. However, some of the items you can glean from the earnings release slash earnings call are on traffic patterns heading into the latter part of Q4, both in the United States and internationally, probably are sending a good sign around what 2025 might look like to investors, and that's why the stock is up as much as it is. One also has to remember that despite the 4% bump today, the stock is only up 5.7% in the past year. There's been spots where it's traded near 300 for the last 2 years or so. So this has been a relatively flat play, especially if you bought near the peaks over here, because there's been a bunch of valleys. This has been a cycle of ups and downs, ups and downs. So it'll be interesting to see what the valuation looks like right now and whether it makes sense to buy today or hopefully wait for a better price in the future. One of the things to remember is that McDonald's has been a very good long-term performer, and a lot of that is because of how its business is structured. So really, McDonald's business model is one of its greatest strengths. And the reason for that is because when you buy McDonald's, you're buying your share of two separate business models, essentially. One that's okay and one that's freaking awesome. And first, let's talk about the one that's okay. When you think about owning a restaurant stock, you probably think about owning a restaurant operator. It's a company that manages everything that has to do with the restaurant, covers all of the operating costs, and keeps all of the operating profits. And that's what this is. This is 5% of all restaurants that McDonald's owns. They own it, they operate it, they run it, they cover all of the costs, and they keep all of the operating profits. That's okay, but the problem with this is, while this is a high revenue business because a lot of dollars go through the restaurant and they keep all of them, it's also a relatively low operating margin business. This is anywhere from 10 to 15%. If it's a well-run restaurant, McDonald's is close to like that 12 to 13% range, which is pretty good, but it's not the other part of this business. The other part of this business is essentially, we are McDonald's, we are an awesome brand name, and we are going to license this brand name to other people who want to open a McDonald's franchise or a McDonald's location. And for that, they're going to pay us royalties. And if we own the real estate, they're also going to pay us rent. So with a conventional license, which is about 55% of the restaurants, McDonald's owns the building and the real estate. So they own the building and the real estate that the McDonald's is on. And then they charge rent to whoever wants to run the restaurant for them. And for the right to have that license, the McDonald's license, they also charge a royalty, which is generally 4% of all revenue that goes in through the restaurant. And then somebody else does everything else. They run the restaurant, they cover all the costs, they keep all the operating profits, but they do have to pay that rent to McDonald's, and they do have to pay those royalties to McDonald's. With a developmental license, McDonald's doesn't own the building, doesn't own the real estate. So somebody else is covering all those costs, but McDonald's still gets those same royalties. So that same $4 of every 4 cents of every dollar that goes out the door, 4% in royalties are going to McDonald's just for the right of using that McDonald's license. With a foreign affiliated setup, it's kind of the same thing. McDonald's doesn't own the building, doesn't own the real estate, but they do get royalties and also equity and earnings representing McDonald's ownership stake in those restaurants. So you can kind of see how this business is pretty interesting because, one, it's a big real estate play. You've got a ton of real estate, a ton of buildings that you own that you're charging rent on. That's pretty repetitive because McDonald's restaurants don't close that often. And on top of that, you get royalties every time a dollar goes through the tills of the McDonald's restaurant. And those royalties are 4% for most restaurants. Starting in 2024, I believe they're changing to 5% for restaurants opened after a certain date. And that's a pretty good business because it's reoccurring revenue, it's low expense revenue, and more importantly, on the opposite side of that, it's very high margin revenue. So this is 95% of the restaurants, and this only makes up 60% of the revenue because, again, the revenue is a lot lower than owning the restaurant fully because you're only getting rent plus 4% of restaurant sales or so. But it's a very high margin business. This is a 70 to 75% operating margin business. It's an awesome business. It's why McDonald's is as good as an investment as it is, because you get this unique thing that really takes advantage of the awesome brand name power that McDonald's has and allows them to collect this reoccurring revenue at very high margins. And that's why their free cash flow margins are as high as they are. That's why their operating margins are as high as they are. And this has become a bigger and bigger part of the pie as the business grows. More and more of their restaurants are franchised and licensed because this is a higher margin business. This is the way they want to go about it. These smaller portion of restaurants are just for them to kind of test out new things, make sure things are running well, and make sure that they know how to operate a restaurant best and translate that to things they could do for their franchisees and improve their businesses as well. So again, 5% of their restaurants are fully operated by McDonald's. This makes up about 40% of their revenue, but only 10% of their operating margin. Then everything else is licensed. It's a franchise model. It makes up about 60% of their revenue, but 90% of their operating margin. This is why people invest in McDonald's. It's an awesome business model. You get all of this real estate as well that's potentially undervalued on their balance sheet. But end of day, the franchise model is what makes this business tick and why it makes investors eager to invest in it. So now that we know that, let's take a look at their actual earnings for Q4 24. Easy to look at the consolidated revenues, the EPS, and say, well, these earnings are bad. But I think the market is more focused on the trends that they're seeing coming out of Q4 and what that means for 25 onwards. A lot of that has to do with global comparable sales. The market expected that number to be negative for Q4. It was actually a positive 0.4%. That's despite a decrease of 1.4% from the US. That is a deacceleration from the comparable sales for the full year. And a lot of that has to do with the E. coli outbreak that McDonald's had. That happened towards the latter part of September, well into October. So that obviously impacted Q4 results. That is offset by really good improvement in the developmental licensed markets. That's China, Brazil, Japan. They really talked about how China is doing very well. And then even international operated markets up 0.1%. So if you look at it from a trend basis, this is moving from a decrease of 0.2% to an increase of 0.1%. The licensed markets decreased 0.3% to an increase of 4.1%. It's all moving in the right direction. The talk around the US decreasing was buoyed by the fact that their results in November and December were really solid. That foot traffic in the US was actually positive. It was just a lower ticket that was driving the comparable sales. That does talk to the weakness that the consumer has right now. And they really talked about how they're seeing weakness in the lower income consumer, especially in the US, especially in the UK. So it'll be interesting to see how that consumer is affected in the next year or two by this new administration. If that consumer strengthens, that's a big benefit to McDonald's. If they weaken, though, it's a big negative to McDonald's. So that's something to keep in mind. This is also a business that has 60%-ish of their revenue in international markets. So there is a currency headwind right now. The US dollar is strong. If that continues to be strong, they already talked about how in 2025 they expect that 20 to 30 cent headwind on EPS. So that's probably going to impact your assumptions around EPS for 2025. But overall, the results here aren't amazing. That's clear. They're not growing quickly. This has never been a business that's grown quickly, but I think the market is taking these comparable sales numbers in Q4, extrapolating them into 2025 and saying, maybe, just maybe, things are starting to turn around. Maybe some of their strategies are starting to work. This is very much an investment cycle for them. They're investing in the app. You can see that there's a big focus in loyalty members and people using the app, driving a lot of their sales through there. That's their sales through to loyalty members up 30% year over year. That's a pretty big shift year over year. So that's a positive. They're investing in the app. They're investing in their tech stack in a big way. That's going to cost a bit between 24 and 27. They're investing in developing more stores. They want to go from 43,000 stores right now to 50,000 plus by the end of 2027. So that's going to be an investment cycle. That's going to mean operating margins are pressured for the next couple of years. Free cash flow margins are pressured for the next couple of years. They talked about how free cash flow conversion is not going to be the 90% they're aiming for, but closer to 80% for 25. And I would expect the same to be in 26 and 27. But the real result is going to be, what does 28 look like? What do margins in 28 look like? What does sales in 28 look like once that investment cycle is done? Because it's really important to figure that out in order to develop a good valuation for something like this. Because again, this isn't a business that's growing a ton. This is a business that had 25 billion in revenue in 2015. In 2025, they're going to have 26.8 billion in revenue, right? This is not a growth business. It never has been, but it is a business that is improving margins, that is focusing more on that franchise business. This is a business that had 18% margins in 2015, is now sitting at 33% net income margin. So almost doubling their net income, almost doubling their free cash flow. That's why the stock has done as well as it has in the last 10 years, 11.7% CAGR in the last 10 years. Its performance, not on the top end side, but on the margin improvement side. But it's also the expansion of multiples. If I sort of look at some of the multiples we're seeing today, and again, this is before the price jump today, you're talking about a 25x-ish P ratio, a 3.6% free cash flow yield, a 2.4% dividend yield. When I look at this chart that says, hey, in the last 10 years, I've had an 11.7% return. Well, if I bought 10 years ago, what was I buying at? I was buying at a 17x multiple, 17 to 20x multiple. That's a good deal off the 25x multiple I'm getting at now. It's a 4.4 to 4.9% free cash flow yield. Now it's in the 3% range. Dividend yields in the 3.7% range. Now it's in the 2.5% range. It's certainly more expensive. The question becomes, what's the right price for something like McDonald's? And as we look at the valuation, reminder, this video is purely for informational, educational, and entertainment purposes only, and is not investment advice. So keep that in mind as we look at the valuation. So valuation-wise, McDonald's, 221 billion market cap, 273 billion enterprise value after debt, capital leases, net of cash, etc. Do note the real estate on their balance sheet. Hard to value that. 50 billion on the balance sheet, probably worth a good deal more since those valuations are likely pretty old. Trading at a 3.3% free cash flow yield, towards the more expensive side of where it's traded in the past decade or so, but a lot of stocks are trending in that area as well. They do have a decent share buyback program, 2 to 3 to 4 billion depending on the year. Cut back a bit during the pandemic, but really brought that back after the pandemic. A good portion of their free cash flow goes towards the stock buyback. The rest goes towards the dividend. They've grown that dividend for quite some time now. They are a dividend aristocrat. Within this spreadsheet, I am raising their future dividends by about 5% year over year, currently paying about a 2.3% dividend yield. If you want to play around with the spreadsheet, hit file, make a copy. There will be a link in the description down below. We've got actuals for 2024, revenue growth in the low single digit from 25 onwards, and then margins improving slightly, and then a big jump in 28 to 32.5. They talked about how 25 conversion, free cash flow conversion will be closer to 80% versus the 90% they typically aim for. I think that continues into 26, into 27. There's a lot of investments they're making into new stores, into their tech stack, into their apps and online capabilities and in-store experiences, etc. So those margins will be pressured in 25, in 26, and 27, but I think that'll benefit 28 onward, which is what I've laid out here. Again, growth doesn't have to be huge here. I don't think the market expects it to be huge. It's just a matter of getting back to growth after a sluggish 2024. This is going to be a combination of maybe 1 to 2% same store sales growth, plus the 2% benefit from the new stores that they're opening in 24 and 25 onward. That's kind of what you're seeing for the next couple of years. There's going to be some headwind from currency, etc., especially if the US dollar remains strong. We've got the buyback, we've got the dividend, not a lot of free cash flow beyond that. You can play around with these numbers as you see fit. Now we get to the valuation. 3.3% free cash flow yield on a 23 actual basis, 3% on a 24 actual basis. Kind of expensive. Historically, this is traded in the 3% range when it's expensive, close to a 5% range when it's cheap. Right now, it's in that 3% range. When I'm valuing it here, I'm putting 75% of the valuation at 4%, 25% of the valuation at 3%, gets me to an expected return of 6.58%. If I want to aim for a 10% target return after dividends, so 7.7% prior, plus the dividend, gets me to a fair value of 263, or about 14% below where it's trading at today, close to a price that it was trading at maybe 7 months ago in July of 24. So this has been up and down. maybe, just maybe, it'll kind of take a step back after this earnings is digested more by the market and move back into the 250s, 260s. That's when this would get interesting. If you think about the valuation here, again, if you're valuing this at a 3% free cash flow yield and you think that's what it deserves because it's McDonald's, because it's more recession proof than a lot of other companies, because it pays a safe dividend and grows that dividend, and because it owns all that real estate that's hard to value, then you're thinking that you're getting a 10, 11% total return, a price that's close to the 450, 460 range in 28, and a fair value right now of about 321. So pretty close to where it's trading at right now. If you're a bit more conservative, you feel like it should be closer to 4% or even 5%, then your total return starts ranging from 1 to 10%. That's why I'm kind of being a bit more conservative here, placing more of that valuation closer to 4%. Again, McDonald's is probably more recession proof than other businesses, but in 2020, during the pandemic, it still dipped 30%. In 2008, during the Great Recession there, it only dipped 20%, which is really nice in relation to the rest of the market. But if you go back to 2000, between 2000 and 2003, the dip was close to 70%. So again, this is a stock that can certainly move quite a bit depending on what the market's doing and how the economy is doing. This is now a much different business than it was in 2000, a lot more focused on those franchise fees, higher margin fees. So that's really good to see. Still an amazing business. That's why I'd love to own it. I have owned it in the past, but generally when it starts creeping up to that 3% free cash flow yield range, I start feeling a bit worried about overvaluation, and I've sold it in the past around this range. If I had it right now, it's tough to say. I'd probably hold it because it's McDonald's. I wouldn't want the tax bill. I don't really have any other opportunities right now, and I already have a bunch of cash. But am I interested in buying it today? Not really. If it drops again, if it gets into that $250 range, gets sort of closer to that like 4% yield into the 240s, 250s, 260s, would I be interested in opening up a position? I think so. I think this would be one that I'd open up a position in certain accounts that are more focused on dividend payments, where I manage accounts for someone who's a bit older than myself, who's closer to retirement or even at retirement, who wants some sort of decent, dependable income that's going to grow year over year. Because I still believe McDonald's is a very solid company, a great business model. It's just kind of expensive right now. That's my take on it. So am I wrong? Let me know down below. Leave a comment. And as always, like, subscribe, all of that good stuff. And thanks for watching. I'm not a buyer of McDonald's, but let me know if you are. And if it hits 250 again or somewhere thereabouts, I will likely be a buyer. So let me know what you think about that. Thanks for watching, and bye.